Thank you for joining us. The following presentation is from a webinar titled Year-End Accounting Standards Update, originally produced on December 17, 2015. The presenter is Janice Snyder with McKonly Asbury. Enjoy the presentation and visit us online at www.macpas.com for more information about our future events and upcoming webinars.
Ms. Janice Snyder. I'm a partner here at McKonly Asbury, and I work primarily in our audit practice. I'm actually our audit segment lead, and I have quite a few topics we're going to cover today as we go through this. So you'll see this is definitely an overview to give you an idea of what the FASB has been up to over the past year and how it's going to affect a lot of your organizations over the next 3 to 4 years. Most of this will be focused on the short term, but Tyler, let's get started. So we're going to start today with a FASB standards update. We're going to spend a little bit of time walking through revenue recognition, as well as some new things changing in debt and inventory. Next, we're going to move on to the new Code of Professional Conduct issued by the AICPA. And then if you're a nonprofit organization or maybe you're on a nonprofit board, we're going to talk about some of the changes that are coming up impacting nonprofit organizations. And then we're going to look a little forward to on the horizon and talk about leases and very briefly some of the exposure drafts that are out there. So let's get started. Okay, this slide is a summary of the accounting standards updates we're going to walk through today. Revenue is one of the latest ones. It's not going to affect most private companies until 2019, but certainly it's a retrospective application, and there's a lot of things you should be considering today, so please don't tune out on that just yet. We're going to go through financial statements and a going concern, and that's going to affect most of you in 2017. Some changes to identifiable and tangible assets that affect private companies, and then talk a little bit about an interesting one, simplifying the presentation of debt issuance costs, so also effective in 2016. If we can move on, Tyler. Then we're going to talk about disclosures about investments in certain entities that calculate net asset value per share, and that's going to affect most of the private companies here in 2017. Simplifying the measurement of inventory. So we're going to talk, it's no longer lower of cost or market, but it's going to look a little different going forward. The next 3 items are Accounting Standards Updates 2015-12, which impact your benefit plans. So if you are a plan, there's going to be a minute or 2 in here for you. And as we move on, Tyler. The next is debt issuance costs related to lines of credit. So the SEC did put some specific guidance out there on lines of credits, and we'll talk about that. And then business combinations, simplifying the measurement period adjustments. And last, we're going to talk about the balance sheet classification of deferred taxes. So let's start with revenue. Certainly one of the most significant topics of the day, certainly going to affect many, many organizations. This project has been going on with the IASB and the FASB for 6 or 7 years. They've been talking about it for a very, very long time. And this final standard was issued in May of 2014. It is effective for public companies in 2018, but it is a retrospective application where you're going to need 3 years of comparative data if you're a public company. And for private companies, it's going to affect you in 2019. And I did note there that this was officially extended by another accounting standards update. And there is no reason to expect that this will be extended any further. The FASB did consider a 2-year delay when they issued that standard update, and there is no indication that they're going to move any further than the 2018-2019 timing. So certainly something you'll want to start thinking about. There are some specific industries that this is expected to impact in a pretty significant way, which will include software and some very specific rules around licensing, which will also impact the entertainment industry. Healthcare organizations, the timing of that revenue, and a lot of discussion around self-pay revenues and the timing of when you're going to recognize that, as well as telecommunications industries and construction industry. When they initially wrote the exposure drafts for this standard, there was a lot of concern about percentage of completion and whether that would still be applicable and how this is going to impact construction companies. They've made some changes to that. So it does seem like on the construction side, definitely some changes, but not as significant as they were once thought to be. The one thing to note, there'll be a lot of additional disclosures required there. So you're going to need more information about your revenue, the type of revenue, the geography of the revenue, and those sorts of things, and the cash flow associated with the revenue. So things you should be looking at as you look to implement this standard. So this standard really relies on a 5-step model, and on the surface, this is great because we take thousands of pages, literally thousands of guidance and revenue related to how we recognize revenue today, and we put it all into one, I'll say simple, but not so simple standard, but it's now all in one place and applies to all industries. So step 1, identify the contract with the customer. Sounds simple enough, could be written, could be verbal, could be done in a lot of ways. Step 2, identify the performance obligations in the contract. Step 3, determine the transaction price. Step 4, allocate the transaction price to each of those performance obligations, whether they're actual services or products. And step 5, recognize revenue when or as the entity satisfies a performance obligation. I'm going to take a moment and walk you through some of the potential pitfalls or some of the tricky aspects of each of these steps. So step 1, identify the contract with the customer. There's a few things you have to have. You have to have approval, commitment by both parties, identification of the rights, payment terms, and you need to be able to support the commercial substance of the contract with the customer. The one thing you have to look at in this step that may not be intuitive, but when you go through the guidance, when you're identifying the contract, you must state in order to have revenue, collection must be probable. And when you look at probable, it has to be consideration of the customer's ability to pay you and also their intention to pay you. So the intention can be a little bit of the tricky part, and that's been talked about in the healthcare industry about self-pay revenue. Can the customer actually pay you, and do they have an intention to pay you? The other place this can get a little tricky is with returns. If a customer has a legal right to return the product to you and you will accept that product, do you actually have a sale at the point in time which you may ship the product, or do you have to wait until a reasonable return period has passed? Moving on to step 2 for potential pitfalls, identifying the performance obligation. So there's kind of 2 pieces to this, which looks a little interesting as you lay it out. The good or service has to be capable of being distinct, and it has to be distinct within the context of the contract. So they are 2 actually separate criteria, although they like to use the word distinct quite a bit. So you have to recognize the revenue when the entity satisfies the performance obligation. So you have to be able to identify what that is, and it could be recognized over time if certain criteria are met. And this over time was put into the standard particularly to address issues surrounding percentage of completion accounting. So percentage of completion accounting in some instances may look a little similar, but you're still going to have to go through this model and evaluate your revenue. Step 3 is determine the transaction price. So a couple of the tricky things here are refund liabilities. So if the entity receives consideration from a customer and expects to refund some or all of that consideration, again, sales returns come back into play here of whether or not that's an issue. And the second one is variable consideration. So it has to be recorded at the probable amount. And as a couple of companies who have been looking into this standard and have been evaluating it, particularly some larger companies, variable consideration is one of the few areas that they're looking at that says this may actually accelerate the timing in which they recognize revenue, because in a lot of cases, those variable pieces were pushed off until a later time until they were known. And this requires you to estimate it and record it at the expected value or most likely value. And step 4, you need to allocate the transaction price to the performance obligations in the contract. So the entity must determine the standalone selling price at contract inception. And you have to allocate that transaction price based upon the relative standalone selling price. And when you look at that, they give you 3 reasonable methods within the standard that you can take a look at. And that's the adjusted market assessment approach, or the expected cost plus a margin approach, or a residual approach. And each one of those are a little bit different, but the residual approach in particular, you can go through if there's 3 different aspects to what you're selling bundled into one price. You think kind of like wireless contracts or your iPhone contracts, how you break those apart, and you can assign a value to, say, the first 2 pieces, and the last portion would be whatever is left for the revenue to recognize there. You also can take a look at onerous contracts and loss contracts as part of this when you're allocating the transaction price, and you would be required to recognize some of those losses at an earlier point in time than may have been required in the past. The last step, step 5, is to recognize revenue when or as the entity satisfies a performance obligation. So within this step, you have to look at whether the entity has a present right to payment for the asset, whether the customer has legal title to that asset, whether the entity has transferred physical possession of the asset, or whether the customer receives and consumes, so that's a second part of that when you think of a service, and consumes the benefit. So as you look at all these, on the next slide, there's a few trickier aspects of that. They give a considerable amount of guidance surrounding warranties. And as you go through the warranty guidance, if you do sell a product that has a warranty with it, you have to look at what type of warranty you're providing. Are you providing a warranty inherent in the contract that the product you're selling will perform as specified? And it's kind of, this is what the customer would already expect. Or are you offering an additional warranty above and beyond that actually may have a cost associated with it, or a portion of your revenue may need to be allocated to that portion of the warranty? And then within that warranty, if it is a separate type of warranty, it affects revenue, and then it could also generate a liability on your financials as well. So you have to look at that. Is the warranty part of the product, or is the warranty something separate and an additional service? The next item is principal versus agent. This can be a little tricky as well, and I think it was tricky under our existing guidance as you had a lot of different industries doing different things with this. But they try to give you really clear guidance around what is a principal, and if you're a principal, you would recognize the revenue gross. So you would have revenue as well as expenses associated with what you are selling. And they look to, you are a principal if you control the good or the service. And there's certain things they put in there you have to evaluate. And one of them is, do you control the sales price of the product? Do you have the ability to negotiate that with the customer? Do you actually control the good or service? Do you take ownership of that? Versus an agent where you really don't have that control over the good or service or that negotiating power, where you would simply end up with your incremental portion of the revenue within your financial statements. I mentioned licensing a few minutes ago. There's certainly a lot of things out there and a lot of criteria. And when they speak about licensing, they talk about patents, software. They pull in the entertainment industry as well with movies and music, media and franchises. And the licensing requirements, as you go through and look at, do you have access to the license throughout the period that you're licensing it? So is it a 3-year license and it's underlying software? Do you have access to it at all points in time? Or are you acquiring your license at a point in time? So is it this version of the software at this particular time? Because that will impact whether you recognize your revenue over time or all at once when you grant that license. So certainly some tricky things to take a look at there. And the last item I mentioned, it's woven all throughout the guidance, is really returns. So when you have customers sending goods back to you, do you have a present right to payment? Is that known? And these are some things that'll have to be looked at very carefully as you look at the new revenue standard. So certainly a lot of items in the details there of revenue, and not something to be overlooked, and something you should be considering as you're evaluating the standard. 2019 seems pretty far away. I know some of my clients have joked they hope they're retired by then, but certainly as you look at 2 years of comparative data, it'll be here 1/1/18, and something that will really need to be focused on throughout 16 and 17. The next standard is disclosure of uncertainties about an entity's ability to continue as a going concern. That's quite a mouthful. But this actually, for the first time, puts the onus back on management to evaluate if there are conditions that raise substantial doubt about the entity's ability to continue. Prior to this standard, any going concern guidance was buried within our auditing standards and was actually the responsibility of the auditor, and to modify their opinion and to take a look at that, or to encourage or require management to have liquidity disclosures. This standard pushes that back on management to make that initial assessment, and if substantial doubt exists or it's probable that they'll be unable to meet their obligations that become due within a year of the financial statements being issued. So on this next slide, it says some of the things that management is required to do, that if substantial doubt exists, they have to go through and assess that and give proper disclosures. And then even if they get to the point where they're assessing substantial doubt and it is alleviated, management still has to provide some disclosures because they went through that process and said, we have certain things that triggered us to take a look at whether or not we would be a going concern. The next standard relates specifically to private companies, and it's certainly the Private Company Council at work. They issued items in early 2014 related to goodwill and being able to amortize that, also related to simplifying certain swap guidance for interest rate swaps. And this was actually the fourth private company standard that they issued during 2014 related to identifiable intangible assets. So this does apply to private companies, as I mentioned, and it does specifically exclude, as anything the Private Company Council does to this point, public companies and non-for-profit entities, and most of their standards also exclude employee benefit plans, although this would certainly not apply to them. An entity can elect not to recognize certain intangible assets separately from goodwill. So under this standard, you can say it's very costly to value our customer-related intangibles or our customer lists, as well as our non-compete agreements. So you can put them into goodwill when you're doing your purchase price allocation, and then amortize them with your goodwill over a 10-year period of time. So the caveat to this is if you're going to put them in goodwill, you have to adopt the private company standard to amortize goodwill over 10 years, and you can't just put it in goodwill and let it sit there indefinitely and just evaluate it for impairment. This next standard, I think the title is very interesting, Simplifying the Presentation of Debt Issuance Costs. So while I can step back and understand what they're trying to do, they're trying to take the cost to enter into a debt agreement and take them out of other assets on the balance sheet and net them against your debt balance. So on the surface, I understand that. It's related to your debt, and we're going to take it out of other assets and net it into your debt. The piece I struggle with a little bit is that if you owe an obligation to your bank, and you owe that bank $10 million, and it costs you $200,000 to enter into that 5-year debt agreement, and you're going to amortize those costs, the $200,000 over 5 years, you actually owe the bank $10 million, but your financial statements are going to show that you owe the bank $9.8 million because it's going to be net of those issuance costs. You will continue to amortize those debt issuance costs and record them as part of interest expense. So it does take that amortization piece now and put it into interest expense. On the next slide, there's a picture of what this may look like. So while the face of your balance sheet is going to change, your assets will go down, but your obligations, your payables, your notes payable, on the other side of the balance sheet will also go down. You're going to then provide this information within a footnote, and you're going to tell the reader, this is what I actually owe the bank in principal, if you look to the bottom of the screen there, and then you're going to show them what is being netted into that obligation amount as your basically deferred financing costs is what we would call them, or debt issuance costs is what we would call them today. So you certainly see a trend as you look at this that there's a lot of things over the years that have been coming out of other assets as they want fewer and fewer items falling into that bucket as some software has moved and some other things have been recategorized to other areas of the balance sheet. This is another step in that direction to limit what's going into other assets. We're definitely moving quickly through these standards, but as I said, this is just an overview, so we're going to continue to touch on some of these. The next one relates to disclosures for investments in certain entities that calculate net asset value per share. So what this essentially does is says net asset value per share can be a practical expedient to be very similar to fair value, but we're not going to call it fair value anymore. And we're not going to have to go through and say, is this actually level 1, level 2, or level 3? We're going to say net asset value just is a measurement on its own. You're going to disclose all the same information for items measured at net asset value, and you're still going to include them in the table to the financial statements, and we have an example of that on the next slide. So you'll just notice the change here, which will save some organizations some time. If you look at that line, hedge fund investments measured at net asset value, they're no longer off to the right as level 1, level 2, or level 3. They're just sitting there in the total, so they still reconcile to the face of the balance sheet, but you don't have to make that assessment and decide which level of the fair value hierarchy do they fall into. So maybe a little win here on the accounting standards is one less step that management's going to have to take. Moving on, we'll talk about simplifying the measurement of inventory. On this one, I always think of inventory, and one of the first things I learned in college is inventory is valued at lower of cost or market. Most of you can probably recite that from all of your accounting classes, lower of cost or market. It's so ingrained into what we've learned as accountants, and I will say to you, not anymore. Inventory will now be measured at the lower of cost and net realizable value. So net realizable value is a little bit different from market because they're putting a very clear definition on this of estimated selling prices in the ordinary course of business, less reasonably predictable costs of completion, disposal, and transportation. So it does eliminate the requirement of a reporting entity to consider the replacement costs of the inventory when they're going through and calculating any potential inventory reserves, but it certainly could take a lot of our inventory values and lower them on our balance sheet at certain points in time, depending on what's going on in your business. Now, it does say when you're looking at net realizable value within this standard that there is an assumption that management will make that there's sufficient demand in the future for the product to be able to sell the quantity of the inventory that you have on hand without incurring significant losses. So you do have to kind of consider that, but the standard assumes that you know there's a market for the amount of inventory that you have on hand. So that will be an important piece of that. Once you make this initial value, net realizable value, and record it at that amount, their intent was not to change any of the remeasurements going forward. You'll just look at your potential reserves in a slightly different way. And as it notes at the bottom there, the LIFO and retail methods started to get really complicated when they started trying to consider them, and LIFO does not exist for IFRS purposes, and this does more closely align us with IFRS, but they were not ready to take on the LIFO and retail inventory methods at this point in time, so they are specifically excluded from this standard. The next accounting standard update relates to plan accounting. And there's actually 3 pieces to this. And this is Standard Update 2015-12. So it did happen about in the middle of this year. And so the first one is for fully benefit responsive investment contracts. They will be measured, presented, and disclosed only at contract value. So if you have a benefit plan, there used to be a pretty significant reconciliation where it would go on the statements at fair value, and then you would back out an adjustment to get it to contract value, which would match the schedules that go to the Department of Labor. Now they say you only have to disclose this at contract value, and it eliminates that reconciliation. So that's a good thing. The next one is plan investment disclosures, also another win. You no longer have to disclose those investments that are over 5% of net assets in a separate footnote to the plan. Part 3 is a measurement date practical expedient. I think I only have one client that this impacted, but if you have a fiscal year end that can float 52, 53-week year end on your benefit plan, it says you can actually pick the year end date, and if you have actuarial valuations and other things of that nature, you can just pick the same date every year if that's December 31st instead of floating between December 25th and January 2nd, or March 31st instead of the floating date around that year end for your benefit plan. So this just lets you use that same date every single year.
Janice, we did have a question that was submitted about this, and that is, what plan years will this apply to?
What plan years will this apply to? So this is a new standard, and this is effective for periods after 12/15/2015. So this does apply to your 2016 plan financial statements. Early adoption is permitted. So as you're looking at the end of your plan year now for 12/31/15, if that is your plan year, you can early adopt this and you can use this practical expedient. So you could start using that today. So please please follow up if you have any additional questions. I like questions. It will help us get through this much more quickly, and I can make it much more relevant to those of you listening. So that was it for the plan accounting. The next item is debt issuance costs associated with lines of credit. So this actually came through on the FASB as a accounting standards update, and it was issued as SEC content because the SEC said, well, now what do we do if we enter into a line of credit arrangement and we've spent some money to enter into that? So theoretically, we would have had an intangible asset for these deferred financing costs, and now we're going to net that asset against our debt. We could potentially have a debit balance on the liability side of our balance sheet, and that was never intended with the debt standard. So the SEC staff came out and said, if you have a line of credit, regardless of whether or not you have a balance on it, the cost to enter into that line of credit will still remain on the asset side of the balance sheet. So they have simplified the presentation of debt, but with lines of credit, there is an exception that those costs will still remain on the asset side of the balance sheet. This standard was issued fairly recently this fall. I think it was just issued in November. So business combinations, simplifying the measurement period adjustments. So as you look at this standard, you always had a 12-month window to true up your purchase accounting when you've done an acquisition. And a lot of times that would spread over a year end. So if you're at 12/31 year end and you do an acquisition in September, you're making some estimates at 12/31 as to what the full purchase price would be and how you're going to allocate that. And you have 1 year to true that up, and that remains the same, but you could still be making some adjustments to that purchase accounting the following spring, March and April as you're closing your books. Before, you used to have to go back and adjust your purchase accounting and essentially restate those amounts as if you had all this information as of your 12/31 year end. This now says you can run it as an adjustment through the current period. You can disclose all of that, and you can move from that point forward and not continuously every quarter, if you're doing quarterly reporting, going back and adjusting that original purchase price. The last one we're going to talk about in terms of accounting standards update is balance sheet classification of deferred taxes. So right now, under U.S. GAAP, we can have current deferred tax assets, non-current deferred tax assets, current deferred tax liabilities, or non-current deferred tax liabilities, and you net your current positions and you net your non-current positions, and in a lot of cases, you have two numbers, some type of current asset or liability for deferred taxes and a non-current asset or liability. This standard really wants to move us to align with IFRS and say all deferred tax assets and liabilities are non-current, and we want them in a non-current position. And their goal is to just have one amount. So you take all what would have been current and non-current deferred tax assets and liabilities, net them, and present just one number on the face of your financial statements. Now, there's one little caveat to that. They want one number by tax jurisdiction. So you still could end up with a non-current asset and a non-current liability, as they're getting a little bit pickier here on breaking out those tax jurisdictions. But the bottom line is you will no longer have anything in current related to deferred tax assets or deferred tax liabilities. And this is not effective until 2018, but early adoption is permitted in presenting this standard. So this will shrink some of our footnotes and eliminate some of those judgments of current versus non-current that currently goes in our financial statements. All right, that concludes the detailed accounting standards update portion of the presentation. So now we're going to move on and touch a little bit about the Code of Professional Conduct, and this is literally 5 minutes. Go ahead, Tyler. I just want you to know, if you don't know already, this code was issued. It was approved in January 28th of 2014. So it is certainly not new, but for those of us in practice, it is effective now. It's effective December 15th. It's 2014, and the conceptual frameworks are December 15th, 2015, and early adoption and the use of this Code of Professional Conduct is encouraged. So the one thing they did is all this standard was a little bit of a mess. Before, we had all of our FASBs and all those things we had to know and know where to go to find them and how to pull all the guidance together before we had the codification. And then in our review standards and compilation standards, they were all kind of written in order, and it was difficult to find things, and they went and codified them and put them in a logical, organized manner. So now they've moved on to the Code of Professional Conduct. So they've created 3 parts that are a little bit more organized, where you start with those for members in public practice, which is the largest portion of the document. It is more than half, as this is a little over 100 pages long, with the most significant portion of that being related to independence. Part 2 relates to members in business. So finally, a section that really didn't exist before, but it says this is what governs your code of professional conduct if you are not in public practice. And then all other members, which are those who are, in between jobs or retired or anything of that nature. And they also have an online tool where it has enhanced functionality where you can search certain items, although I find the PDF easier because I can search that as well. So we move on. Some of the significant changes, as I said, it was organized by rule before, and now it's kind of grouped and organized in a more intuitive manner, and it allows you to look into the sections of whether you're in public practice or whether you're in business. The piece of this that is new is they put a conceptual framework in place. And as I mentioned before, the conceptual framework is applicable for December 15th, 2015. So certainly something to think about as it's December 17th. It is applicable now. So it incorporates a threats and safeguards approach designed to assist you in working through a methodology where you identify threats to compliance with the rules, evaluate the significance of those threats to determine if you're at an acceptable level, and then if it's not an acceptable level, you have to apply certain safeguards to eliminate the threats. And if you go to the next slide, this shows you what the conceptual framework would look like. If you have no threats, you're good. You can proceed. If you evaluate the threats and they're not significant, you then proceed. If they are significant, your answer to that is yes. You have to look at the safeguards and say, what are my existing safeguards and my new safeguards? And they go through a lot of what are safeguards, from our professional rules to trainings to the laws and regulations, all the way down for those in public practice to what is in place in your firms. And that list is rather extensive of potential safeguards. Then you evaluate those safeguards. And if your safeguards are sufficient, threats are at an acceptable level and you can proceed. And if they're not, then you need to stop and not proceed with that work. I included here on this slide the definition of acceptable level. And it's the level at which a reasonable and informed third party who is aware of the relevant information would be expected to conclude that a member's compliance with the rules is not compromised. The interesting piece of that is reasonable informed third party. I've had individuals ask me, is that a professional? Is that another CPA? Well, certainly if you're up to the ethics board and there's some sort of issue, that is professionals, but this standard is simply a reasonable and informed third party. So something to keep in mind. Next, we're going to move on. I told you that would be rather quick for the Code of Professional Conduct, but we'll move on quickly to not-for-profit accounting. I don't believe there are a lot of nonprofits on this webinar, but some of you may be on nonprofit boards and you may be affected by this. So you saw there are changes ahead. So there was an exposure draft issued, and the comment deadline was August 20th, 2015. And this affects both not-for-profit entities as well as healthcare entities. So it kind of takes both of those sections. Some of the healthcare entities have some concerns with this. But if you look at the balance sheet, we currently have 3 classes of restriction, from unrestricted net assets to temporarily restricted and permanently restricted. This wants to move to 2 classes of restrictions: net assets with donor restrictions and net assets without donor restrictions. So really temp and perm kind of end up together in this model. And that does significantly change not only the face of the balance sheet, but also the income statement, as well as where certain items will end up on the cash flow. The next piece of this is operating performance. So they really want to take the income statement and focus certain measures and subtotals on availability for use for mission. So which of your funds are being used for your mission and how much of them are available. They want to look at expenses by nature and function and actually have that be part of the income statement. It excludes investment income and financing activities from the operating performance and that key measurement that they're looking at there. And it would also have categories there for board restricted items like quasi-endowment funds that will be shown separately. The next piece, there's kind of 4 large portions to this. They look at the cash flow. And for anyone who's done a direct method cash flow, this is potentially very bad news. But it will require a direct method cash flow statement, which can be time consuming, and to set that up, and to classify more items as operating cash flows that have not been classified that way in the past, including purchases of long-lived assets, contributions restricted to acquire long-lived assets, and sales of long-lived assets. So that's a very, very different focus of this standard, to move those items into operating cash flows. And then liquidity. Sorry, there was one more point on that slide, Tyler. And the last item is liquidity. They want more disclosures around how the organization manages liquidity and future cash flow needs. So the bottom line with a lot of this is they want to really change the face of the statements and have more disclosures, and more disclosures. So certainly they want to expand and lengthen the financial statements of not-for-profit organizations. So some of the biggest concerns about this, particularly as you look to the liquidity disclosures and the changes in the cash flow of moving those long-lived assets up into operating, there is definitely some concerns that why would not-for-profits be the ones spending the money to lead the way in making these changes to operating and non-operating activities? If you read the comment letters, they said, why are we looking to the nonprofit community to potentially do that? There is general agreement on these standards with 2 classes of net assets as opposed to 3. And then the HFMA is looking at this on the healthcare entities, that this will create further deviation between for-profit and nonprofit healthcare organizations. So the last piece that they're really struggling with is the liquidity disclosures and the self-defined time horizons by the organization, that's causing some concern as the organization gets to look at and create that criteria. But as we look at all this feedback, I do know there have been some discussions as well where they're saying that the direct method may be a little strong. I have some clients where it's required by regulatory agencies, but they have talked about at some of their meetings about potentially not requiring the direct method cash flow through this, as they've seen the comment letters that have come through. So we'll see where that one ends up. The next item that's affecting non-for-profits is the Uniform Administrative Guidance. And this affects if you now have a single audit or what was under A133 standards, as some of you may know. This really changes those requirements to bring them all, like there was A133, A121, and different cost principles that were out there. And this brings them all under one set of rules and one set of guidance. And there are very specific items around the procurement area, which I will walk you through, and audit changes. This is effective for fiscal years December 31st, 2015 and June 30th, 2016, and a lot of it goes back to the grant and when that grant was made and the guidance that was in place. So on the administrative guidance, as I said, it's moving from A133 to a term that seems to be the one that's being used the most, to uniform guidance. And it says that the organization must establish and maintain effective internal controls and establish that they are in compliance with the laws and regulations. And so that was a very strong word that they used about must. But then it also says that you should be in compliance with COSO. It says COSO and the Green Book or the Green Book within the standard, which is just the government rules that are pretty similar to COSO, and that you would need to go through, and that COSO is a very good framework to use with the control environment, risk assessments, control activities, information communication, and monitoring. So here's an example of different things you would look at in terms of your control environment. And there's control environment monitoring activities, information and communication, to go through and evaluate some of the requirements of COSO for setting the tone at the top, establishes ethical standards of conduct, evaluates adherence to ethical standards, things of that nature, that it's not that you need to meet every single requirement, but that you need to have enough of these items in place to say that you have a strong control environment to meet those requirements. The good news is there was a grace period to implement this standard for 1 full year that began on December 16, 2014, or December 26th, sorry. 2014, but that we are now ending that grace period and that organizations do have to follow these standards. And within these standards, organizations must, and this is absolutely required, must have written procurement policies, must engage in full and open competition, must ask for actual or potential conflicts of interest and have that written, and must maintain records for all procurement activity. And I think the next 2 slides gives a little bit more guidance on the procurement. So they lay out within the standard, if you read this, it's actually a rather short section, but a very important section of the standard, that micro purchases are purchases that are less than $3,000. Small purchases are from the $3,000 to the $150,000, and then there's a sealed bid process you have to go through for greater than $150,000, and a competitive proposal process to go through as well for items greater than $150,000. And if there's anything that is sole source, you have to have guidelines around that as well, that if they're unique or a public emergency, then you wouldn't have to go through this process, but you still have to have a documented process for that as well. So if we go to the next slide, we'll look at what they call the procurement clause within the standard. And it gives you some guidance around if it's a micro purchase, you're able to just go out for under $3,000 and buy those items. But once you get into the small purchase level, $3,000 to $150,000, you need to be evaluating other sources and where you're going to buy that and have an approval process and POs in place and things of that nature internally. And then it gets more stringent as you go over that $150,000 level. So organizations should definitely have these policies in place and have them documented and be consistently following their documentation that's in line with these standards and have a trail that is able to be audited. So there is a little bit of good news with the uniform administrative guidance that's out there, or uniform administrative requirements, that the audit threshold for what was called the single audit was $500,000. It's now increasing to $750,000 for federal funds, and you're still required to make the records available for review and audit by federal agencies if you're under that $750,000 threshold, but you are not required to go have your own single audit. And then the audit coverage amounts have also been reduced. If you're a low-risk auditee, you used to have 25% of your federal funding audited. Now it's down to 20%. And if you're a non-low risk or high-risk auditee, as I would sometimes call them, but non-low risk auditee is the technical term, you have to have 40% of your funding audited, where the previous threshold was 50%. They also increased the audit finding threshold to $25,000. It was much lower at $10,000. And then the single audit report under this uniform guidance will now be posted publicly on the Federal Audit Clearinghouse. So for nonprofits, if you are a nonprofit, there's definitely some new rules and new standards, which could be a little bit cumbersome to implement. But there is some good news in this with the increased thresholds, and definitely thousands of organizations that will not be required to have a single audit anymore. There is some ways you can read this article about knowing your rights and how to protect them from the Council of Nonprofits on their website, that more costs are reimbursable as direct costs under this standard, and that there is a de minimis amount if you don't have a negotiated indirect cost rate of 10% that you should be able to obtain on your contracts. And it goes through and gives you some tips on how to discuss that with the government agency and what your recourse may be, because the government entities granting you the money may no longer limit payments to nonprofits to only direct costs. So a little bit of good news in that. So we have one more topic left I have for On the Horizon, and we have 11 minutes, so we're probably finished in about 3 or 4. It's definitely an important topic of leases. These have been talked about since 2006. It is an ongoing project that's for a very long time. It had an exposure draft 2010, 2011, it's so long ago I'm forgetting the exact dates at the moment, and then this was re-exposed in May 2013, and they continue to deliberate this. This has been an interesting journey. As I know, in 2014, some of the large leasing companies as well as very large firms started saying the leasing standard's dead, it's not going to happen. I was a little skeptical, and then you go onto the FASB's website and they start having meetings again in October 2014, and they're making decisions. They've had several meetings this year on leases, And where they are right now is they're anticipating a dual model approach with Type A leases, which will apply to almost all leases where you record an asset and a liability on your financial statements with amortization and interest expense. And then they've carved out for Type B leases a very small portion of leases that is if you're leasing really small portions of buildings where it's not a significant portion of that building to record a single line lease expense on your financials, which would look a lot like our current rent expense may look like. But if you go to the next slide, we lay out here what this would look like on your balance sheet. So the news is all leases are expected to come onto your balance sheet unless they're less than a year. And they're going to go on as a right of use, that ROU asset, which is similar to an intangible asset. So this will certainly increase your long-term assets. You will then also record a liability at the net present value of the lease payments as a long-term liability. So long-term assets are going to go up. Long-term liabilities are going to go up pretty significantly by this standard, since it affects everything you lease, from buildings to vehicles to office equipment to computers to phones to the list goes on and on. On the expense side, this is where it's really interesting as we move away from a lot of those operating expenses and rent expenses and things of that nature to interest and amortization. So as you move these things to interest and amortization, the interest on the debt and the amortization of the right of use asset, we're certainly going to increase EBITDA. And a lot of those EBITDA multiples are very important to deal structure and things like that. And on the cash flow, cash payments for interest and cash payments for Type B leases, so those ones that are small portions of buildings, will end up as operating cash flows. And the cash payments for principal will end up in financing, so look a lot more like debt and our capital leases today. The decisions that they've reached to date, and their last meeting was in November, is to include the extension options. So if you have a 10-year lease with a 5-year extension, you only have to include that 5-year extension if there's significant economic incentive to exercise. So we'll have to evaluate the significant economic incentive, like declining rents and things like that. They have given an exemption for short-term leases of 12 months or less. They have clearly said that all related party leases that are at legally enforceable terms will come into this standard and should be on the balance sheet. And the one thing they've done for non-public companies is said you can use the risk-free rate in place at the time of the lease and not have to try and figure out what the interest rate may have been. So they're saying final standard in Q1 2016. Perhaps. They've put a date out many, many times and continue to move it. I think I'd be a little surprised if this doesn't go final at some point in 2016. We'll just see if that actually happens in Q1. The last thing I gave you here was a slide for some of the exposure drafts that are out there, with the most recent one I have being issued on December 3rd. There's just 2 points I want to make. I highlighted a lot of things there on revenue, because there still remains a lot of questions out there on revenue and how we're going to clarify that and how that's going to be implemented. So they're certainly working on that. And in the middle of the page there, they're working on notes to financial statements, assessing whether disclosures are material and trying to put a definition around material so that when a standard says you must disclose at a minimum, which a lot of standards say that, if it's immaterial, management will be able to make that judgment call based upon this definition and potentially exclude those things that in the past would have been required, whether they were material or not. So hopefully looking forward at some of those things they're working on gives you an indication of what is to come. We didn't have a lot of time to talk about that today, and since they're not final, I think that's okay. We'll be able to talk about those in the future. So, my goodness, we've covered a lot in the last 50 minutes, and I've talked quite a bit. So we do have just a minute or two left for questions, and I welcome for you to send questions directly to me. There's my email address. I love to talk technical accounting topics and technical standards. I definitely enjoy that. And I do see here that we have one question that's come in on the Accounting Standard Update on Intangible Assets related to private companies. Does this only apply to business combinations on a go-forward basis, or can amounts currently be treated as customer relations, be combined with goodwill, and be amortized? So you're able to look at this standard in connection with amortization of your goodwill, as long as you are amortizing that goodwill. But this, the business combinations and the intangibles, as you take a look at them, these do have to be applied on a prospective basis. So if you have a lot of those customer-related intangibles that have already been allocated and already been valued, you'll have to look at the standard and see if you can amortize them going forward, but you would not go back and reset all that purchase accounting because the standard is effective prospectively. So please contact me if you would like me to clarify that any further. Okay, I think that wraps up our webinar for today. I'm going to turn it back over to Tyler. Thank you so much for your time.
Thank you once again for joining us for this presentation, produced by McKonly Asbury. We hope you join us and participate in our upcoming events. You can stay up to date with news and learn more about our upcoming events by visiting us at www.macpas.com. Thanks again and have a great day.